RZLV II, ticker RZLV, is trading live at $4.69, which is a significant move up of over 5.6% on the session. Now, the immediate expectation when you see a small cap II stock that has traded between $1 and $8 in the last year is that this is just noise, another volatile day in a long string of chaotic moves. But the reality of what's happening under the surface with RZLV is far more structured and far more significant. This isn't just retail speculation. Today's volume, already clocking in around 6.8 million shares, is part of a much larger ongoing debate between some of the biggest players on Wall Street about what this company actually is. We are seeing a fundamental conflict in real time, and it's all centered on whether this company is a high-growth AI pioneer or a cash-burning machine on a collision course with insolvency. Let's establish the common ground, because this stock is confusing for many. Most investors see the AI in the name, they see it lumped in with other speculative names like SoundHound, and they see analyst price targets at $10, $12, even $15. The expectation is that this must be an undiscovered gem, a ground floor opportunity. Others see the de-SPAC history, the 52-week low of $1.07, and the astronomical net losses, and they assume it's a ticking bomb. The reality is that both of these views are too simple. RZLV AI isn't just a concept. It's a company in the middle of a very aggressive, very expensive strategic pivot. The recent news flow confirms this. Just 2 days ago, on October 22nd, the company announced a major leadership reorganization. This isn't the kind of move a company makes if it's quietly failing. This is a move to align the company for what it calls accelerating global growth. Before that, on October 10th, the company announced it had completed the acquisitions of SmartPay and Subsquid, a digital payments platform and a blockchain data platform. This tells us the company is not just trying to grow organically, it is actively buying the components it believes it needs to build its vision of agentic commerce. This is where the expectation of a simple growth story runs headfirst into the brutal reality of the company's financials. When we look at the last reported quarter, the numbers are stark. The company posted revenue of $3.16 million. That's a real figure, but its net loss for the period was a staggering $28.93 million. This is a cash furnace. The balance sheet shows cash and short-term investments of $9.86. Now, look at the cash flow statement. Cash from operations was negative $9.9 million. This is the central conflict of RZLV. The company is, by its own filings, burning through more cash in a single quarter than it currently has on its balance sheet. The only reason it is still operating is a $10 million injection from financing activities. This is a company living quarter to quarter, funding its aggressive acquisition and growth strategy entirely through external capital. In an environment with high interest rates, this is one of the riskiest business models you can possibly run. The 52-week low of $1.07 wasn't an accident. It was the market pricing in this exact existential risk. So, what does the company actually do that requires this much capital? RZLV is building what they call brain commerce. The idea is to create an AI layer that sits on top of e-commerce, moving beyond simple keyword search into conversational, agent-based commerce. It's an ambitious B2B platform. Their partners are listed as Microsoft and Google, which provides a halo of legitimacy. The acquisitions of SmartPay and Subsquid, a digital payments platform and a blockchain data platform, tells us the company is not just trying to grow organically, it is actively buying the components it believes it needs to build its vision of agentic commerce. This is where the expectation of a simple growth story runs headfirst into the brutal reality of the company's financials. This brings us to the short sellers. There is a very serious, fundamentally driven short position against this stock. It is not just a high cost to borrow meme play. The latest data shows 15.76 million shares are currently held short. That represents about 10.55% of the company's entire float. This is a significant institutional bet that the company's strategy will fail. The short thesis is painfully simple and very compelling. The company is hemorrhaging cash, it has negative shareholder equity of over $14 million, it has massively diluted shareholders over the past year with a 74.9% increase in shares outstanding, and it has no clear path to profitability without raising hundreds of millions more, which will further dilute existing holders. The short sellers are not betting against the AI idea, they are betting against the balance sheet. They are betting that the company cannot possibly achieve its goals before it runs out of options. What's the actionable insight here for investors? You need to track this data. You can find short interest on platforms like Fintel or Ortex. The 10.55% float is the main number, but look deeper. The days to cover is only 1.31. This is very low, and it is not a sign of a squeeze setup. It means that because RZLV has such high average trading volume, all 15.76 million shorted shares could theoretically be bought back in just 1.3 trading days. This gives shorts an easy exit. A high squeeze risk stock would have a high short interest and a high days to cover. RZLV only has one of the two. This suggests the shorts are confident and not trapped. Investors should also be watching the off-exchange short volume ratio, which yesterday was 33%. This shows a consistent, steady pressure from short sellers that isn't just happening on the public lit exchanges. What's your read on the high short interest? Do you think this is smart money identifying fundamental flaws, or is it an overplay by funds trying to crush a small cap hound? Now, just as the short thesis seems overwhelming, we get the other side of the story. This is the institutional reality that complicates everything. In mid-September, RZLV announced that institutional ownership had officially crossed 10%, and the names on the list are the ones that make everyone pay attention: Citadel, BlackRock, Vanguard, Jane Street, and State Street. These are not small speculative funds. These are the largest asset managers in the world. This is the bull counter-argument. These firms, who have entire departments dedicated to due diligence, have been building new positions in RZLV. This was further validated by the company's inclusion in the Russell 2000 and 3000 indices, which forces index funds like BlackRock's and Vanguard's to purchase the stock. The bull case is that these institutions have looked at the cash burn, they've looked at the acquisitions, and they believe the company's projection of hitting $100 million in annual recurring revenue in 2025 is achievable. They are betting that the acquisitions and the new management team will be the catalyst that turns the corner and that the stock is trading at a massive discount to its AI peers. This is the battle you are seeing in the stock price today. The 5.6% jump is not random. It's a fight between the fundamental short thesis and the institutional accumulation thesis. On social media, you see this split perfectly. You have retail traders frustrated with the volatility and the dilution, and you have others pointing to the analyst targets and the AI badge. The truth is that the retail discussion is a sideshow to the main event. The real fight is between institutions like Citadel and the anonymous, fundamentals-based short funds. Looking forward, the path for RZLV is balanced on a knife's edge. The expectation is for a high-risk, high-reward outcome. The reality is that this is a binary bet on execution and financing. The single biggest risk is the balance sheet. The company must raise more capital, and it will likely happen soon. This will mean more dilution. The question is whether they can raise it on good terms, backed by strong revenue growth, or on bad terms from a position of desperation. The primary catalyst will be the next earnings report. We must see if the acquisitions of SmartPay and Subsquid are translating into actual reportable revenue. The company's $100 million ARR target for 2025 is the benchmark. If they can show a credible path to that number, the short thesis will begin to collapse. If they miss and cash burn remains high, the 52-week low of $1.07 will look like a near-term target. I want to know what you think. Comment below with your honest take. Is RZLV's agentic commerce model and the recent acquisitions a coherent strategy, or are they just buying growth they can't afford? So, to summarize today's analysis, we started with the simple expectation that RZLV is just another volatile speculative AI stock. But the reality is that this is one of the most fascinating and high-stakes battles on the market right now. It's a company with a clear, ambitious, and incredibly expensive vision. It is backed by some of the world's largest institutions who are betting on that vision, and it is simultaneously being targeted by a large, logical short position that is betting on the company's horrific cash burn and negative equity. The stock price isn't just noise. It is the direct result of this institutional tug of war. The expectation of an easy win for either side is a fantasy. The reality is that this company's future will be determined not by hype, but by its ability to fund its operations for another 12 months.